everyone, and a very warm welcome to today's webinar. With the West Asian region marked by geopolitical tensions, the strain is becoming increasingly visible in steel markets. We are seeing this through disrupted trade flows, tightening scrap availability, rising freight uncertainty, sharper price volatility. While this situation is centered in one region, its ripple effects are being felt across global supply chains. I'm Mayuri Phadnis, India editor at Waste and Recycling magazine, and it is a pleasure to be moderating this session today. For those joining us for the first time, Waste and Recycling magazine is a leading trade publication covering the recycling and waste management industry across the Middle East, India, and beyond. It serves as a definitive voice for waste management professionals, recyclers across all streams, traders, and industry professionals across India. Meanwhile, BigMint is one of the most trusted commodity intelligence platforms, providing price assessments, market analysis, and data driven insights across steel, ferrous, and non ferrous metals, agriculture, and logistics value chain. But before we begin, a quick note for our audience, please use the chat box to share your questions for our panelists at any point during the session. We'll do our level best to address as many as possible, particularly towards the end of our discussion. So now let me introduce today's topic. We'll be looking at steel markets under pressure, trade, scrap, and supply chains in a volatile world. This aims to unpack what is changing on the ground and what lies ahead for the industry. We have a strong panel of experts with us today. So, let me quickly introduce our panelists. I'll get into their biodatas later, but we have with us Rohit Agrawal, General Manager, Steel Recycling Business at JSW Steel Limited. We have with us Javed Ahmed, founder and CEO of Qaryan International. We also have with us Surabhi Pandey Shukla, Regional Vice President, Northeast Asia at Sea-Link International. And we are also joined by Hemant Dewangan, AGM Steel Operations at BigMint. Before we move into the discussion, I'd like to invite Hemant to set the context with a short presentation. Hemant, you can talk about how geopolitics is driving disruptions, price volatility, and more cautious buyer sentiment.
Sure, Mayuri, thank you. So let me share my presentation. Good afternoon, everyone. So I'm going to present a context setting for today's webinar. So the subject is the impact of geopolitical conflict on the ferrous scrap at the steel market, and the steel market is under strain for this. So let's have a forward view what's happening. Before going, just have a quick about BigMint. So BigMint is a trusted platform for price reporting, market intelligence, and consulting for commodities. Basically, clients use our services for taking the critical business decision making. And we cover all ferrous, non-ferrous, coal energy, scrap recycling, logistics, and agriculture. And these are our products and services. A small disclaimer. Then coming into the top 10 producing countries in top 10 steel producing countries in 2025. So basically, if you see around more than 50% is considered by China. The total 1849 million tons of steel is produced all over the world. That is into 2% year-on-year decline. China is around 961 million tons, that is around 4% decline. However, if we see Japan, South Korea, and Russia, they are into a decline of around 4, 5, and 3%. However, if we talk about the India's context and the South Asia, it's keep on growing. So the center of gravity is in the Southeast Asia and the India, where the steel market is growing. Also, WSA projects around 1.3% demand rebound in CY26. That is contingent to a geopolitical stabilization. Now, coming into the how the industry has performed about in FY25 and FY26. So, if we see the contrast of the global softness with India, uh, generally it was a strong year if we see the last quarter, but on the 9 months from April to December, it was not good for the steel fraternity because the demand were not good, prices were in the declining stage. But the December to March month was extremely steep price increase due to various factors. Overall, if we see, there is an 11% increase in the steel production, either it's crude steel or finished steel. We have seen around 29% increase in the steel exports. Steel imports was into 23% decline, but this is due to the policy measures that has been taken, like safeguard duty in the case of HRC. Also, anti-dumping duty is introduced for Vietnam in case of HRC. So this type of policy shift has declined the imports. Steel consumption, if we see, it has risen by around 7%. So if we see the production is rise by 11%, but consumption is at 7% increase. Also, if we see the iron ore production has increased, also the iron ore imports has increased by 92%. Almost coking coal production is at the same level or a 2% decline. Scrap domestic production has increased around 25%, and the scrap imports have dropped. So scrap imports due to last 3 months was not favorable for the imports due to the war situation. Also, if we see on CY basis also, there was a decline in the steel imports. Now coming into demand. So India's steel demand is projected to grow. If we see steel prices will stay elevated because of the project economics, and the demand will keep continue to grow in this particular way. Now coming into the snapshot of the global iron and steel prices. So what has happened in this particular year? We have shown on a heat map. So coking coal was the major game changer in terms of input cost. It has peaked around 263 per ton in the month of February. That's our monthly average prices. The risk from the Australia, and also there is a good demand in the Chinese steel mills. So these were the effect. However, on HRC front, if you see, it was a very sensitive market for the 9 month, either it's HRC or rebar. So in the April to December month, the prices were in the decline phase. From December onwards, you may see most of the columns are into the green phase, right? We are showing the graph trend, what has happened into the China, Japan, Russia, and the India's FOB offers in case of HRCs. So this was the trend. If you see the shaded region, the prices were quite below the average price of the previous year, but the things have changed after December. Now, why this has changed? So this has changed due to the two factors. One is the input cost pressure. Another is the war situation that has affected the inflationary pressure. Again, going into some details, what has happened into the raw material, scrap and metallics and steel, because it's a global dynamic where a lot of raw material are coming imported to India, and then a lot of finished exports are being shipped to other countries. So in case of raw material, we have seen in iron ore prices, there is a change of around 10 to 13% on YOY basis. However, here coking coal prices are not seeing growth, but in around quarter-on-quarter basis, coking coal prices also risen by around 10 to 15%. So input cost pressure is the greatest thing that has escalated the cost and prices for the steel sector. However, finished steel has not been risen at to that extent if you see the average prices. But in the last 3 months, the prices are now at the 3-year high level. Wherever on the November month, it was into the 5-year low level. So this was a price volatility and dynamics in the steel industry in these past 3 to 4 months. Now coming into the HRC and rebar price spread. So this is how the rebar and HRC's price spread is have been shifted. So currently, both HRC and rebar product as I told after December it has been risen. So a lot of events have been captured in this particular CY 24 and 25. So this is the price trend. Now coming into the imports. So a lot of policy measures have been taken that I have explained previously. Now, if we see the landed cost of imports is higher than the domestic prices, again due to the safeguard duty. But however, we have seen the steep pricing is in the Indian steel mills HRC prices. However, in case of global, there is an uptrend, but the pace of the global uptrend is slow. So if we compare quarter on quarter basis, the benchmark Chinese prices have risen by around 7.5% on quarter basis. However, in India, the HRC prices have risen by around 17 to 18%. So this is the shift what we have seen. This is one of the product that we have as a forecast of HRC. So structurally, if we see, it's a moderate recovery that has been driven by the strong demand and the seasonality, also the import discipline. We see that what is creating bullish is the infra acceleration, the global supply tightening. What is turning it to be bearish is the import surge. If import is coming at a parity price, also the demand, if demand will decrease, then the price there will be effect in the prices. So this is what we forecast for HRC. So prices are now at 3-year high at the stable at this level. However, in rebar, because 60% of the Indian rebar are manufactured by the electric route, either from electric arc furnace or the induction furnace route. However, blast furnace route is having the good input cost pressure. That's why the prices have been risen at this level. Downward risk is there for patchy real estate market, a potential demand shift down if there is. So let's see. You can see the full forecast reports on the BigMint website. Now coming into the our BigMint India Ferrous Peak, that's a flagship event. The 3 days event that is focused mainly on the iron ore, pellet, DRI, scrap, steel, and coal. This particular event, we are expecting more than 500 plus delegates along with 105 exhibitors, more than 150 plus sponsors, and around 69 plus speakers. So this is a very good and flagship event that is coming on 19th to 21st of August at Kolkata. So thank you so much for this. I will hand over the stage to Mayuri.
All right. Thanks, Hemant. The price dynamics seem to have shown an interesting flip in the recent times compared to the low levels in November. I also want to take a moment to mention an exciting upcoming event for everyone in this industry. Media Fusion, the parent company of Waste and Recycling magazine and a leading events and media company based in Dubai and Mumbai, is proud to bring to you the second edition of the Bharat Recycling Show, India's premier platform bringing together recyclers, technology providers, and policymakers from across non-ferrous, ferrous, e-waste, battery, end-of-life vehicles, and tire ecosystems. The conference would be held from August 31st to September 2, 2026 at NESCO, Mumbai. As a precursor to this Bharat Recycling Show and the co-located Plastics Recycling Show India, Media Fusion has joined hands with Maharashtra Pollution Control Board to organize the Recycling Vision series. This is a series of seminars to be held in Pune, Nashik, Nagpur, and Ratnagiri. The first of this series will be held in Pune on April 27th. Please check your chat boxes for more details on BRS and the registration details for Recycling Vision series. Um, we can we have the poll, please? We'll do a quick poll. Okay. Yeah. So, which factor is creating the most pressure on your businesses right now? We have around 30 seconds to answer this question, and then we'll soon see what people have to say. All right. Can we have the results now? Oh my god, it's the same across non ferrous and ferrous. We have 55% people saying freight costs and logistics. Well, price volatility and uncertainty also seems to have received a lot of votes. Um, Javed, would you like to tell us what do you think about these readings?
I think he's on mute, Mayuri.
Javed, Javed, are you on mute?
Yeah, can you hear me now?
Yes.
Hey guys, this is Javed here, and good to see you guys. And thank you, Mayuri, having me here. And see this poll showing that that everybody in the same ship where the logistic issues is going on. So I believe entire worlds are passing through the same problems, and I'm being with the majority what the people saying the freight cost and logistic issues is getting more worse and more challenging for our business. So I'll go for this majority what people are talking right now.
All right. Okay, now let's get into the panel discussion. I have introduced our panelists, but let's hear more about them. So we have with us Mr. Rohit Agrawal, who represents JSW Steel as General Manager, Steel Recycling Business. He has worked with three majors in a career spanning over a decade and a half. He has been an integral part of various decarbonization drives and has been heading scrap supply chain initiatives with a special focus on the domestic circuit. He is a convergent thinker and passionate about building the growth story of the Indian recycling industry. Then we have Javed Ahmed. He is the founder and CEO of Al Qaryan International. He is based out of Dubai and Al Qaryan is a leading global player in metals industry. With over 25 years of experience in recycling ferrous and non-ferrous metals processing and trading, he has built strong international partnerships and driven sustainable business growth across the Middle East, Asia, Far East, Europe, and the USA. Before entering the metals sector, he began his career as a banker in India, gaining a solid foundation in finance. His leadership combines deep market knowledge with strategic foresight, making him a respected voice in the global commodity space. We also have with us Surabhi Pandey Shukla. She's the regional vice president, Northeast USA at Sea Links International. As regional vice president for the Northeast USA, she leads business development and sales initiatives, focusing on expanding market presence, building long term client partnerships, and driving revenue through innovative logistics solutions. With over 15 years of experience in the logistics industry, she brings a strong understanding of end to end supply chain operations, from shipping execution to strategic sales leadership. We also have joining us Hemant Dewangan from BigMint. He is AGM Steel Operations and he brings with him deep expertise in steel market analysis, pricing trends, and raw material dynamics, offering a data driven perspective to today's discussion. Now that the context is set, we'll move forward to panel discussion and understand how these developments are playing out across trade procurement and logistics. Javed, coming to you first. From a Middle East trading perspective, how is the current situation influencing scrap availability and flows on ground?
Thank you, Mayuri, for your questions. I think this is a great question, and I think across the world knows the Middle East is passing through a tough time, right? And we are in middle of center of the situation. What is going on right now? So, as long as the whole Middle East is passing a tough time, the challenges of the business are becoming more challenging than even we can think. So for me, if I talk about the Middle East today, and Middle East is a very large segment. If you go into details, it is talking many country. But if I talk about my where we are based on, like a Dubai or GCC, which is a more closer and more impactful. So if I look at like a situation in the UAE today, it's a become the biggest challenges today we got for the shipping, that's called logistic part, right? And I think I'm sure that the whole audience and the panelists know this situation is going on. So for the ferrous scrap, is if I talk very specific of the ferrous scrap, is in this country are no problem. We got a good percentage of the ferrous scrap in UAE. If I talk about the numbers, I can happily share the number that almost 150,000 ton ferrous scrap is being generating every month. If I calculated, do the simple math, it's close to be a 2 million ton scrap is being generated from UAE. So if I talk about the entire, because I'll go one by one in the country so you guys can understand what is going on and the ferrous scrap and the rest of other base metals, if anybody wanted to know, regardless any steel, so we can discuss on that. So steel today in this situation, the scrap are more available into this region where I'm sitting right now, like a UAE, and consumption of the scrap is a lower. So if I'm going into the details, I can tell you almost 2 million ton scrap is available in UAE itself. And now only few mills who having the melting shop like Emirates Steel or Arabian Gulf and all those, and they are not buying even 50% of total scrap, right? So the most of remaining scrap, almost 50%, is going to be out of the country, neighboring country. Used to be go to Pakistan and Bangladesh, and some extent in India. India has been almost closed due to many reasons and tariff and all the support system. But the two biggest buyer from this region, it is one of the Bangladesh and Pakistan who are buying, because short transit, you can load today, within 3-4 days, metals reach to their country. Now, the yard people, I'm just keep talking in reality last 1 month, they don't know where they can ship because the shipping costs are killing, and even you are ready to pay the shipping, you don't have access to ship your metals. Strait of Hormuz has been closer. Even essential item is very hard to getting into, right? So the scrap mainly steel metals is the lowest scrap. It cannot sustain if the high freight rate is going on in the market. Always any scrap is dependent on how to manage and sustain with the lower of freight rate. So today, everybody know that freight is the king. Freight is the guy who taking the decision where metal moves. So for me, I see people are holding the cargo. They are not able to ship. They are finding the many way to shipping here and there, but they are not. The good news that we learned yesterday, that ceasefire is been placed. We are keeping our finger in cross that might be is going to be get good news. I'm sure my colleague Suvi will give us better idea on shipping side, how they are reacting after having this ceasefire. So going forward from UAE is one of the steel market is suffering. They are not able to ship. But if I talk about the Saudi is different dynamic altogether. UAEs have the more scrap. Saudi is a different ball game. Saudi need more metals, scrap, because their primary feedstock is not reaching to steel mills. And whatever the scrap is available, they're buying, and they are getting shortage of the scrap in the Saudi Arabia, right? So Saudi have like a more demand for the scrap rather than depending on the primary feedstock. Primary feedstock today, why they are hand to mouth? Because Strait of Hormuz is closer. Their iron ore come from outside, either whether coming from Brazil or from many country. They has to come, right? And that is, maybe I'm talking about more than 10 million ton, right? And those are not coming, so they need to run their plant. And there's no options, because I was talking to one of the biggest steel mill, Hadith. He said, man, if I didn't get next 30 days my primary feedstock like DRI and all, my plant will be stopped anytime next month. So this is the situation. So some country they need a scrap too much, shortage is there. Some country have a more. If I talk about Qatar and Kuwait, it's a similar, because all most of countries they have the ban over scrap. So scrap is not going anywhere. They are sitting into ground and they're selling to locals. Yeah.
All right, that's interesting to know. Are you seeing suppliers hold back cargoes, delaying shipments, or diverting flows to other markets? Especially since you mentioned the elevated freight rates.
Yeah, they don't have any other options rather than holding in UE, right? UE, they don't have any option. They wanted to go anywhere. They wanted to move their cargo, but the way, I mean, if you look at like a water charges now reaching like a roof, like 1,500, 2,000, and plus the freight charges, they cannot justify for $300, $350, $380 cargo value. They cannot, so they have to hold back. So I know many suppliers in the UAE, they're holding back, waiting for the better time to come to ship, or they're justifying that they need liquidity. They are just getting the metals, selling on the lower price, lower than $300. They're losing money. They're booking the loss and shipping the material because they need to run their plant, right? So yes, they are doing so. But in Saudi, there's another problem. Qatar, there's no problem because there's a ban from the day one. So you don't have any option to export anywhere, right? You brought the materials, pack it, process it, and ship to the mills. So you don't have any choice. So on UE, yes, they are holding back.
All right. Since we are talking about freight rates, Surabhi, let me bring you in here. How have current disruptions altered the way the traders are planning shipments, and what impact is this having on freight markets and vessel availability?
Hi, Mayuri. Thank you for having me here. This is a very pertinent topic in this market. So yes, to answer this, I had actually reached out to few traders and few shippers to get their perspective. How are they managing their trade? And yes, I did get to know that their focus right now is cost efficiency over speed. Shippers are waiting where it's possible, but they also need a more cost-effective option because the scrap has to move, the trade has to keep going on. They are exploring business opportunities in Latin America, Europe, Mexico routes because these are not much affected by the conflict. Freight rates, I mean, the carriers have added war risk surcharges, emergency surcharges. So yes, the freight has gone up a lot and looks like it's going to remain uneven. Even after the ceasefire, we don't expect anything to go down. If the ceasefire is extended, then also the prices are expected to remain uneven. I wouldn't say it's going to go up, but yes, it's going to be choppy. Also, due to the conflict at the Strait of Hormuz, the fuel cost has gone up. That is affecting not only ocean, but also rail cost. So we are seeing local domestic increase, trucking increase, everything has been impacted. Regarding your vessel availability and we are seeing a lot of vessel congestion. Vessel rotation has become a major issue, and that is causing a lot of delay in the supply chain. There are several blank sailings as well due to the congestion at the transshipment hubs. And that is in turn leading to shortage of equipment in a lot of US ports. Because I'm based here, I can speak more about the situation that's going on in the US at a lot of rail locations, Detroit, Atlanta. We are seeing container shortages. So the overall supply chain for this reason has been delayed tremendously. I mean, yes, it's the freight, but at the same time, the blockages, the choke points that are in the transit, that has created a ripple effect in the supply chain. So yes, it is. Everything is disturbed right now.
All right. I know. I mean, thanks, Surabhi. I know it's super early for you. You're based out of the US, and thank you for joining us. Um, Rohit, from a steelmaker's perspective, how are these shifts in scrap availability translating into procurement challenges on the ground? Are you seeing a greater need to diversify raw material sourcing or adjust procurement strategies in response?
Hi, thanks, Mayuri, and good afternoon, everybody on the panel. Good afternoon to the industry enthusiasts who joined this webinar, and thankful to BigMint and Waste and Recycling Magazine for having arranged the same. If you look at India as a country, we have a very high import bill. We import a lot. If I look at the steel industry, starting from iron ore, some bit of iron ore, we import thermal coal, we import coking coal, we import ferrous scrap, we import precious metals, we import rare earth metals, so the import bill is high. So a global disruption, and especially a global disruption of this order, would obviously have an impact on a country like us. So, I mean, it's a no-brainer. Yes, there is an impact. How specific this impact has been lately, if you look at the prices of thermal coal have increased by more than 20% over the last 1.5 months or so, has had an impact on the price of sponge iron. The domestic sponge iron prices have increased by more than 10%. Scrap in Turkey, in spite of having a very high base, is still higher by 10%. Looking at it over the last 1 month or so, the prices in India of imported scrap, look at CFR, Navasheva, or even the scrap coming from the Southeast Asian nations, or coming from even down south, the prices have increased by more than 10%. So there has been an increase. The like-to-like increase in FG prices, in spite of them being at a 3-year high, as one of the panelists have said, is not as much as the raw material prices. So yes, there are challenges when you see the cost pressure so high, and that not being similar to what the FG price increase is, because the demand does not increase organically as fast as these cost of raw material does. There obviously pressure does get developed. So that is how we are looking at it. Procurement certainly is a challenge. If I look at our company altogether, we are procuring about 55,000 ton of ferrous scrap on a monthly basis across 3 of our mother plants in the west and south. There are challenges. More than 60% of scrap in India is obsolete scrap, and most of that obsolete scrap requires gas cutting. There isn't much of mechanized processing of scrap in India even today. I mean, we are still taking baby steps. Of course, we are advancing, but we are still a lot dependent on gas for our cutting. So you go to the market, you'll find that the prices of LPG are being, very, let's say, particular. The prices of LPG have increased even 4 times, the industrial LPG. So anybody wanting to cut scrap has to pay 4 times more. So yes, there are challenges. What I take from here is that, we start considering scrap as less of a commodity and more of a strategy. Maybe that is the way forward. That is how, things can improve in future. As far as your second question is, concerned, I think you're talking more about the how do we look at diversifying our strategy on procurement. We as a company look at a more structured approach to our sourcing. Okay, of course, I mean, we have largely been iron ore based company, but then since we are expanding on scrap, we have a plan of increasing our scrap consumption by more than tenfold in the next 3 or 4 years. Of course, there needs to be a structured approach. We are building our domestic ecosystems, and it really is heartening to see that the last 1 year has shown significant increase in domestic scrap availability in India, and the dependence on import has slightly come down, which is the effort that all of us together as an industry are making. So what we are doing is we are building an app, I've also said, on different platforms. That app connects us closer to the place where scrap actually gets generated. We come closer to the aggregator, right from the onboarding to the time the finance and accounts of that particular person gets closed. It's all there on one particular app. that is the level of reach one app can take us to, especially if it's an industry like this, which is as fragmented as it can be. I don't see any industry as fragmented as scrap is today, in India. So we're doing that as a strategy for the domestic scrap. As far as strategy around procurement of scrap on our OE or our customers are concerned, so we're looking at offtake. We're looking at really doing that material circularity part, wherein they give us the scrap and we give them the steel. So that kind of partnership towards the long run is what we are trying to build. So yes, these disruptions, of course, you need to be prepared. I mean, the new normal is a less normal. That's what that is the takeaway. So we are preparing ourselves structurally. We are preparing ourselves for the long run. We are doing this for sustainability, and the kind of measures that we are taking. I hope to a large extent we remain protected by these disruptions going forward.
Okay, that's interesting. We also have like a lot of government support to generate scrap domestically, if I believe so. I think that should also help domestic scrap generation in the time
Yes.
to come.
Yes.
Um,
The policy that related when the steel recycling policy came in 2019. So there'll be a lot of improvisation over that and see how domestic scrap availability and especially domestic scrap aggregation and processing can be improved in India. Yes.
yeah. Okay. Javed, coming back to you, are buyers in Middle East changing their sourcing strategies for finished steel in response to the current volatility?
Mayuri, this is like, there's no option with anybody, either your buyer or supplier, to change the strategy in this situation, because the problem is not that you have a metals you are not able to buy. The problem is a logic system, like a shipping problems, right? So the all buyer, if they wanted to change, they got an option to change. What they can change, they have to buy from across the world, right? They can buy from China, they can buy from India, they can buy from Japan, South Korea, they can buy from many countries wherever they buy. But the metals flow into the same Strait of Hormuz, right? So the whole region dependent on the shipping, right? So based on my knowledge, what I know about last 25 years in this industry, the entire GCC have enough installed capacity to produce all metals what exactly the country needed. Okay, so if you talk about the long product in steel, they got enough production to fulfill their requirement. Either talking about UAE, Saudi, Qatar, or rest of every country, including Iran as well, right? So, but if you talk about a flat product, yes, no, there's a gap, there's a deficit between what they consume and what they produce, right? So for the flat product, they have to depend on import, whether the China or Japan, India, they need to export that a special grade for flat product like a plates and HR coil. And mainly it goes in infrastructure in industry. Those also has to come the same way. They don't have other alternative option to receive them, right? So today, if I look at the whole GCC requirement and consumption, they require almost 38 to 40 million ton, right? And they do their self almost 22 million, right? So the gap is flat product, right? And flat product by hook or crook, they have to buy from outside. So what I look at into the strategic sourcing, I didn't see any chance at this moment if somebody wanted to buy, and after having this disruption in this region, they want to change, they will not be succeeded much and more, because it's not about to buy and stock it, right? The line of shipping is the same, the way go, like all shipping inwards and outward going for the same reason, right? So I'm not seeing any chance based on my knowledge that anybody can, based on a strategy, they can decide in the future. Yes, they will be more focal to understand how much they have to have for their own feed, right? They could be that kind of reason. But today, they'll not be going anywhere rather than buying from the locals, because if feedstock come in, they can get the metals, right? Feedstock is a problem today. If the import from the outside, they can import your feedstock from outside and feed to your steel mills to produce what you need it, right? So for me, in the long terms, I'm not seeing the big changes into the sourcing mechanism to change. They're going to depend on that. They'll stay there, and I'm sure they're going to find a better way. But the most important, the steel mill is going to work behind to how to make sure to have their emergency feed stock if situation is being gone this situation, because this region have no experience last many decades, right? Especially UAE and Saudi, they don't have any experience kind what is happening today. So they're going to work more into the backward integration to how to have more stock in the place to feed to their country and feed to their customer. This is what based on my knowledge. Yeah.
All right. So it's more like a cautious buying behavior. So our
Yeah.
regional sourcing, so to speak.
Sorry, say again, the cautious buying behavior, right?
Yeah, cautious buying
Yeah.
behavior, shorter contracts, or a shift towards regional sourcing.
Yeah.
Barring
Yeah.
HRC, of course.
So they could be like the more strategically know that what they need it if something's happened. We discuss in what you asked me, and I'm going to repeat it again. Yes, when the uncertain situation is arise, the peoples are going more, I mean, more worried than on the normal one, right? So if I'm not in good shape, including me, if I'm going to make a bigger contract, I'll be rather thinking to one or making a smaller contract, because it's not about the money to lose. We don't know whether supplier can supply, the logistic shipping line can bring the materials, whether we can handle on the port. So by default, it will always go is a bigger or smaller company. It doesn't make any big change. It's going for the short contract, right? They wanted to make like they want to make a year. They will make for 3 months. They wanted to order 50,000 ton. They order only 10,000 to see how situation is going to be evolved, right? So in this situation, in this region, yes, it's going to be shorter contracts. Yes, for sure.
All right. Since we were talking about about HRC, Hemant, let me bring you here in discussion again. With HRC at 3-year high and coated steel at 4-year highs, are these flat steel price surges more supply driven, linked to geopolitical scrap shortages, or cost driven?
Mayuri, basically, what happens, HRC prices, why this is on 3 years high due to the both effect, like from the cost pressure as well as there is a effect of demand as well. So demand is good in India during the last quarter of the fiscal because scrap is not directly related to for the this kind of fat product, but the supply dynamics and the tightening of or the availability of the particular HRCs was the concern. Also, the policy measures, because in April 2026, there was a safeguard duty measure for 200 days provisional. And then on November month, there was a 3-year safeguard duty has been staggered for at the rate of 12, 11.5, 11%. So this has kept the import to very limited quantity, and these are the major factors. So the all synchronized effect has shown around what I told 17% increase in the particularly HRC as a base product. Now coming into the coated or galvanized product. So basically, the galvanized product base metal is HRC, and then you have to have galvanizing or other processes, other coating processes, where in certain processes gas is involved. And gas prices, as you know, has risen by around 50 to 60% already. And that too, at the availability of gas is also crucial, because industry is now getting around 60% of their monthly average consumption. Over and above the 60% or 70%, they are started at a very high rate. So mills are now attracting a very huge inflationary pressures in the input cost, as well as there is a problem in the standalone mills where the gases are procured from outside, because integrated mills can even use coke oven gases, but the standalone mills, they have to procure gas from the suppliers. So these are the major concern which has having the effect, and Due to this, steel buyers are facing issues because they have to buy prices, they have to buy the steel at higher prices, and that is in overall steel value chain, this is affecting.
How about rising freight and energy costs? Are they eroding Asian and Indian finished steel export competitiveness?
So one thing is price, as Survi told, as because there is a shortage of the vessels as well as the price. The biggest thing is the uncertainty. That is major concern, because if you see the area in which the war is going on, that is the second favorite destination after Europe, if you see. So Europe also, there is an ambiguity of CBAM that yesterday only got cleared what will be the prices. But again, a lot of ambiguous situation is there, a lot of uncertainty situation is there. So if I'm getting a good price for a mill, if I'm getting a good price in the domestic segment, why to bother about export? So this is the current scenario of the Indian steel industry. They are focusing more into domestic because of the better price realization rather than the export.
All right. So, Ruby, building on that, freight rates have been highly volatile in recent months. What are the key drivers behind this volatility right now, and how are shipping lines and logistic providers adapting to the in the near term?
Yeah, so Mayuri, we all know the key driver right now is the geopolitical instability in the Middle East. Shipping routes are heavily disturbed because of the increased voyage time, fuel consumption, increased freight rates. All these factors are in totality leading to a huge instability with supply chain. We recently saw an incident that happened at the fuel storage facility at the port of Salalah in Oman. Now, that also affected the vessel rotation a lot across the Indian Ocean and the Asia-Europe corridors. So that increased the congestion, the supply chain, freight, everything. Like as we have been seeing. The global fuel prices have gone up. Carriers have introduced war risk surcharges, emergency fuel surcharges. So yes, all these have led to a high volatility in the freight market. And like I said, it continues to remain because there is a lot of uncertainty in the market right now. Also, after the Chinese New Year, we saw a growth in demand. The manufacturing had increased, but again, due to vessel rotation issues, capacity constraints, and the congestion at the transshipment ports, the freight rates continued to increase. So for the last few months, we have been seeing that it has been constant, that the rates are only going up. So all these factors are adding to the increase. So all I can say is freight market is right now not moving in a single direction. It remains to be volatile and uneven. Shippers should expect short-term increases until the current situation settles down. And there is operational settling as well, not only just the geopolitical, but the operational things like the container shortage, the vessel rotation, everything has to come in place for freights to become firm. And I think that will take at least a quarter to come in place. Now, with regards to what shipping lines are planning, what they are doing, like Javed Bhai said, they are working on, altering their contracts to short-term contracts. Same way, the carriers are now willing to alter the contracts. They are willing to, come with short-term contracts that has better transits available. Like they can allow hybrid freight. They are now allowing hybrid freight contracts. They are also maintaining contracts with backup terminals in place. So in case there are some issues midway, they can, go to other transshipment ports. I think you must, I don't know if you're aware, but we had recently seen that when this conflict happened at the port of Salala, a lot of cargo that was going to Port Qasim got diverted to India midway, and then through India it was sent to Pakistan. So yes, carriers are now being ready with all these changes on their contracts. They also have a dedicated risk team that is keeping a check on the security threats and accordingly, optimizing the routes so there aren't more issues while the cargo is in transit. Also, essentials like energy, food are being prioritized by the shipping lines over other commodities. So, metal scrap being an exempt commodity, of course, is not given as much priority as other cargo. Carriers are also sharing capacity and routes. So there are a lot of carrier alliances that are happening that we are seeing. That is one more step to help move commodities smoothly.
All right. So you mentioned backup routes and hybrid contracts. So what are
Yes.
the other contingency planning measures that are becoming standard practice to ensure continuity of supply in such uncertain conditions?
I mean, it's pretty much the same that both carriers and the agents are into flexibility of agreements, whether it is regarding freights, whether it is regarding transit time. Even the shippers are right now more comfortable if the cargo takes longer, but it's important that it is safer. So that has become a prerequisite, and I think that's going to be the norm for some time if the situation persists.
All right. Thanks a lot, Surabhi. Rohit, coming back to you, how are procurement strategies evolving in this environment? Are steelmakers becoming more conservative, or they are still taking calculated risks?
Yeah, so you'll have to take calculated risks. I mean, the way you are placed, you cannot be conservative. In fact, going forward, you will have to take more and more calculated risks. Just to give an illustration, we are a 35 million ton steel company. As far as scrap is concerned, every 1% increase in scrap charge would mean 350,000 tons of scrap. So that calculated risk has to be taken. Now we'll have to choose the sources well from where you would like to procure your scrap. Can you develop a long-term strategy around it or not? Would the quality, because we have traditionally not been scrap users. Like I said, we are more of a hot metal company, or we use hot metal into our steel furnaces. So that quality part is very, very essential. That's why we have not been able to take those risks as far as imported scrap is concerned. Most of imported scrap is HMS and HMS 8020, but then HMS 8020 going directly into the steel furnaces, I mean, you're not very sure of it. So that quality part, we'll have to see, and some calculated risks we'll have to take, and we are building our processing capabilities accordingly, so that even if such scrap is imported from various sources across the world, we are able to build that processing capability and use it the way we want to use it in our furnaces. So going forward, there'll be more of import. There is a possibility of more import from a company like JSW Steel as well. So yes, to answer your question, of course, I mean, that risk-taking ability, or we are improving on that.
All right, and are steelmakers building larger inventory buffers or trying to stay lean in
See,
this uncertain?
particularly about scrap, you cannot maintain a high, inventory of scrap, because scrap is a very low margin game. Your profitability erodes with a small swing in the market. If I compare the cost of my hot metal with scrap, even today with the increase in coking coal and iron ore prices, scrap would still be about 25% higher than my hot metal. So of course I cannot probably rely on huge inventories or physical inventories at the yards, but yes, building a proper relationship, that is the that is the idea. You have a strong pipeline of orders. You look at long-term contracting, like we said. So that is the idea. So we are trying to improve on that.
Okay. Coming to Hemant, what is your scenario outlook for HRC and rebar prices over the next couple of months? Your best case versus worst case scenario, especially considering margin pressures between finished and semi-finished steel.
So, Mayuri, basically what I have already told, there is a input cost pressure. So, if we relate the input cost of iron ore and coking coal for an integrated steel mills, mainly for HRC and the BF root rebar, we feel that around already mills are having the order booking of around 1.5 months. So, till 15th of May, we are not seeing a very less probability to go downside. Prices may consolidate at this level or may increase up to some extent. So pre-monsoon, we are expecting a good demand in case of VF root mills. Coming into the IF root mills, where the rebar having the major chunk of the product, where the scrap is one of the root, as well as the DRI is also there. So DRI, if you see, it has the effect of the iron ore pricing. DRI already, as Mr. Rohit already told, it has increased around 10%. Already scrap is also increased, as well as there's a less of imported scrap in India due to the logistics issues. So this will again be under pressure. Pre-monsoon, we expect a moderate demand, but prices may consolidate at this level. So to give the context or conclude, till May we are not seeing a big downside, but once the monsoon will come, as well as the demand slows down. So from June onwards, prices may correct to slight levels.
All right. And with China's steel prices rising and India's strong output growth this year, how do you see global cost pressures influencing domestic flat steel demand in the near term?
So, if we compare the benchmark China prices, so China prices have not risen up to that extent. So this has risen by around 7.5% on quarterly basis. However, Indian prices have increased around 15 to 20% in case of finished steel, whereas finished steel has different pricing. So, particularly if I talk, it will not influence much because there are less of imports will come from China due to the major safeguard duties and QCO compliances is also one of the factor. So that will not affect, but however, we have to see the other FTA countries like Japan, South Korea. So if domestic price will increase again, and then global prices with the FTA countries are not increasing, so there is a viability of import along with the safeguard duty in place. So if it becomes cheaper, then only it will happen. So very less probability of that, but again we have to watchful on this particular thing. But China, as far as China is concerned, the prices are far ahead. The landed cost of imports for China is far ahead than the domestic prices. So no risk from China.
All right, interesting. So before we move on to audience questions, I'd like quick closing perspective from our panelists. Rohit, let me start with you. So, what do you think? What should the market brace themselves for, be it in terms of raw materials or pricing, or what should steelmakers really be preparing for?
I think the steelmakers should really be preparing for more and more disruptions. In fact, if you look at how the last 5 years has been, starting from Russia, Ukraine to Red Sea, and now to the West Asia crisis, and then every other day something new happening. We need to be prepared. the first mill that will start making 1000 beams, something that we have not seen in the past. So, and maybe products such as those which are closer to the customer. So that is one. The second is like we've all heard about sustainability and how important green steel is going to be in the future, not just for CBAM, but then also for the targets that companies and the country together has taken on what its CO2 number is going to be like. So there'll be more and more of scrap usage, because that while it was the first, it continues to be the foremost lever of decarbonization till today. I mean, there isn't any other decarbonization technology that is scalable or is technologically mature that it can be used to the extent scrap can be used. So there'll be more of scrap usage. A lot of our material circularity chapters will start coming in. You will see we tying up, or companies like us tying up with a lot of customers or consumers. There'll be more of EPRs coming in to ensure that this circularity actually happens and the implementation goes well. So I think we all need to prepare for a very different kind of a future from what it has been in the past. This is more of building new strategies, innovating every day, rather than carrying on the same mundane way of operations. Thank you.
Thank you so much. Javed, from a trading perspective, what is your outlook for scrap flows and pricing in the near to medium term?
Mayuri, see, my perspective always is in positive side to say today we have a tough time, tomorrow will be a good time, right? So anything you see bad today means if today is a black like night, then tomorrow will be day, right? So situation is bad for right now. If I talk my business is okay because we are an international company. We are diversified across the world. So the only these region business we are hampering at this moment. But I'm very hopeful that the whatever is happening today is going to be go over. Okay. So supply chain have issue at this moment as Survi ji said that it's not going to be come down in the shipping in near term. So it's going to be more curious than that what you are seeing right now because we are not essential part that we have to be carry out on the first priority or second priority. Might be the third or fourth priority is going to be right. So we have to be prepare ourselves that we are going to see the worst situation, but always after worst situation the good days comes. Like for one of the example you seen it when the COVID came, 2020, everything is being stopped, right? Chopped. People said, hey, where we can go, what you can do, we don't know, right? But after COVID, it was there, then the whole market changed and the business become one of the biggest business for everybody after a year later, 2021, 2020, 3 or 4 as on, right? So for me, I'm seeing a positive. Yes, it's tough time, as I said initially when I was talking the first your question, but I'm seeing a great because whatever is being damaged today is going to build tomorrow for sure, right? They're not going to leave them as abundant that okay, this is going for ever as it is. So I see the big challenges today what we can't even expect, but this is happening. But I'm sure there is going to be remedy for that, and things is going to be bounced back on market. So commodity market is going to be one of the essential item to building whatever happening today, regardless. You look at like assets, equipment, building, infrastructure, whatever you are seeing today is being damaged is going to be rebuilt again. So I'm very hopeful for the positive in coming 3 to 6 months when the war is over.
All right. Surabhi, if the current situation persists, what are the long term impacts that you foresee in movement of commodities?
Mayuri, with regards to the long-term impacts, I would say that the commodity will continue to move. Just that it might move at a higher baseline price and with volatility. Volatile supply, with so much destruction happening around the world, there will definitely be a huge demand. Just that with all these hiccups in between and choke points, there will be volatile supply, like I said. Global trade will adapt to this supply network gradually. It's a matter of time, and that will make it more flexible and better prepared for future shocks. I would say, and I think the industry is going to emerge stronger with this. Um, Countries will start holding more reserves because of the supply chain delays. And there might be storage infrastructure investments that will come on a rise as well. So everything leads to some other bigger opportunities. So I think that will also be one aspect that a lot of countries will now look into. With everything that's going on, I think cargo insurance premiums will also be on a rise. People would want to have a better cargo insurance in place, so that the cargo is better taken care of. So that will also become a new norm in the future. So yes, like I said, with war risk, with insurance premiums, everything becoming standard, the prices will go up, but commodities will move. The cargo that was earlier routing through Strait of Hormuz or Suez Canal will now be routed through Cape of Good Hope, which will be longer, but it will be safer. So longer voyage will be the norm, not an exception. And the commodity prices right now will be unstable and eventually should stabilize with the geopolitical situation getting settled. So yeah, that's what I feel is going to be the future.
All right, so Ruby, I know it's super early for you there. Would you like to stay for Q&A, or do you want to carry on with your day?
Yeah, I would request if I can take my leave and get prepared for jumping on the emails, etc. So yes.
I know the shipping market is in chaos right now, so I think
Yes.
it was wonderful to have you with us today, and have a good day.
No, thank you so much. Thank you so much for having me. And yes, C-Link is always there to help you guys move your cargo. So yes, reach out to me if anything is needed with regards to supply chain queries and trades.
Yeah, thank you so
Thank
much,
you.
Ruby.
Thank
Yeah.
you.
Thank you,
Thank you,
Subi.
everyone. Thank
Take
you.
care. Take
Bye.
care.
Thank you.
Thank
Bye.
you.
All right, Hemant, a quick closing view from you as well. What should producers in finished steel segment watch most closely over the next few months? Um, Export competitiveness, import trends, or domestic demand recovery?
So, mostly if I talk about one by one, so producers as well as I will also throw the lights on the buyer's view. So, producers should watch, there is a less of import, so domestic producers should produce as much as they can because demand is good. Also, I would like to like to tell the buyers that there is no panic situation. So, the prices will not rise much due to uncertainty. This has been risen in this past 3 months. It was a steep increase in the prices, but as far as availability or the inventory is concerned, producers are putting their level best to produce with the highest production efficiency. However, there are some plant maintenance in the April or May month with the major producers. Or it will not affect much of that volumes because export volumes has been uh, taken care of that because exports are now less. So this is about the export, import, and the domestic scenario. As far as the domestic demand is concerned, domestic demand is healthy. At least for next 2 to 3 months, we are forcing a very healthy demand. June will be again the watchful month from where the demand may slow down and prices may correct. So this is a wait and watch situation, and because of this war, nothing. I mean, it is not good for any ecosystem. So inflationary pressure will be there, and there will be a resistance from buyer at buying at these higher prices. So this is my overall outlook for the coming next 2 to 3 months.
All right. Thank you, Hemant. We'll move on to audience questions now. We have a question. If the ceasefire holds, could we see a short-term correction in steel and scrap prices? Would like to take this one?
So I can take that. If the ceasefire is there, there will be short-term correction in terms of IF-based mills because they run on sentiment. But as I told that major mills are booked with most of the mills are booked with 1.5 months and 2 months. Even in special project, in products, they are having 2 to 3 months of order booking. So, and major producers are very much resilient in case of pricing because they don't increase the prices too early as well as they don't decrease the prices because there are a lot of logics behind that. So, sentiment-based market may have the effect, but again, we have to see after the particular duration what will happen. So it's a dynamic situation. It's a new normal. So prices will remain volatile. So buyers and dealer distributors should be ready with all the volatile situations. That is my say.
All right. Also, what is the impact of CBAM kicking in on the export volumes as well as DDP price basis after January 1st, 2026?
Uh, Again, I can take this question, Mayuri.
All right.
Yesterday, there was a confirmation for the CBAM certificate prices of around pound 75.36 per ton of the CO2 equivalent. So this particular thing will get added. However, in terms of export volumes, so due to the uncertainty, the export volumes has already been dropped. But being Europe as a favorite destination for the India,
Mm-hmm.
even uh, exporters want to export their as per the quota limit whatsoever we have. We want to fulfill the quota as a Indian manufacturer. Also, there is an ongoing export in case of CRC,
Mm-hmm.
HDI. This an ongoing export with an average volume with a good average volume and with a very good pricing.
Right.
HRC sometime it's hold for around 1 to 2 months because of the uncertainty in the logistics or the freight market.
Okay. All right. How does the counterpart how is the counterparty being handled? Counterparty risk being handled with respect to seller non-performance due to rising scrap prices and freight issues. Anyone to
Yeah.
take that one? Yeah.
Uh,
Hi, Javed.
well, yeah, Mayuri, if I understand this question, if somebody is asking like from the affected area, like Middle East, if anybody buying from here to their country, respective counter party country, and they got a hit because the war is happening right now. The freight rate has been increased. They are not able to get the vessels. The supplier is not able to engage anything to any deposit a container on the port. So things are going like a chaos, as everybody knows that. So the simple answer for this question that okay, there's always a contract is giving the force majeure on contract side that anything's
Mm-hmm.
happen like war, you can be talk to your supplier or customer saying that man this is happening because this is beyond my controls, let's figure out together. Or you can simply say this is not happening right now, whenever it's going to be happen we can do that. So at this moment a supplier or customer if bothering somebody why you're not shipping, why you are charging this, it's really unreasonable task to discuss today because everybody losing money, every single supplier or customer. I'm for both side talking, both sides are losing money. So let's put on the contract, all contracts says a force majeure. So situation is going on against situation means it is going under force majeure. So I think the counterparty is not liable to say anything or receive something. It's simply say it's a force majeure. You should wait, or you can discuss on mutually, and you can take a next level. Sorry, we can't hear you. You are mute. You are on mute.
Yeah.
Mayuri.
Yes. Sorry. Am I audible now?
Yeah, sure.
Yeah. Also, now that the import prices have narrowed, how will import scenario be in the near term? For you, Javed, if you're answering, you can look at it from exports. Although um,
Uh,
Middle East
so
may not be the exporting country, right?
Yeah,
So I can take Mayuri if you want.
Okay. Yeah,
I
yeah,
please
yeah.
go.
I already answered this on the landed cost matter. So landed cost will be the concern from the FTA countries because after adding the safeguard duty as well, it's very close to the domestic prices in India. But however, I have said that China is not a risk at this stage. But we have
Mm-hmm.
to see what happens in the China prices because in some of the segment we have not seen much demand after the holidays. So wait and watch situation. But again, there is a QCO compliance where the BIS is authorized to give the license to the mills uh, for the imports. So there are certain already policies which are in place, uh, but FTA countries will be watchful, and if there is a big gap between the FTA landed cost as well as the domestic prices, then there will be a viability of the imports from Japan and South Korea mainly.
All right. Thanks a lot, Hemant. Thanks a lot, Javed, and thanks a lot, Rohit. All of you gave us an insightful session. As we close, it is clear that the current situation is reshaping how steel markets operate, from trade flows and scrap availability to freight dynamics and procurement strategies. Whether this proves to be a temporary or more structural, the industry is being forced to adapt quickly. But before we sign off, we request you to take a moment to share your feedback through the poll on your screen. Your inputs will really help us improve and shape future sessions.